We are the Oundle School Monetary Policy Committee. This presentation will examine 4 areas: costs and prices, demand and output, financial markets, and finally, international outlook. As exemplified by the fan charts, Bank of England projections for inflation have been relatively consistent with reality, and our own projections for inflation are shown on the blue fan chart. With disinflation in the market, with the current level of inflation at 1.7%, and the UK's growth forecast increased to 3.4% for 2014, the UK economy is recovering. However, uncertainty still exists, much of which comes from the influences of costs and prices, which my colleague will now explore.
The CPI headline rate is currently at 1.7%, a 4-year low, with the main downward contributors being lower petrol prices. The sterling ERI has depreciated slightly since our last meeting, however still remains over 10% higher than where it was 12 months ago. Finally, oil prices have fallen by around $5 since our last meeting, which I shall discuss later. Import costs account for around half of CPI goods prices, and these components have contributed around 0.7 percentage points to the headline rate over the last 12 months. While sterling fell during the financial crisis, the real trade-weighted effective exchange rate has appreciated by 10% since March 2013, helping import prices to fall 0.7% in January. As the US economy strengthens, the pound may lose some of its value against the dollar. However, a strong UK recovery should ensure that sterling's strength is maintained. This, combined with weak world export price inflation, should ensure that the contribution to CPI from import prices fades over the medium term, as represented by the shrinking balloon. Commodity prices have generally fallen over the last 12 months, with the Economist Commodity Price Index down 5% year on year. Agricultural prices should stay relatively stable. However, adverse weather conditions could provide an upward pressure. Future markets show most prices declining or remaining relatively stable over the next 12 months, while sterling's recent strength should reinforce this. Therefore, we believe commodity prices are likely to put a downward pressure on the headline rates of inflation over the forecast period. Energy prices will be a major contributor to CPI over the forecast period, directly through household bills and indirectly through higher business costs. Last year, energy tariff rises were smaller than expected, mainly due to a reduction in green levies. However, energy tariffs are still 6% higher than where they were a year ago, and we believe this upward trend is set to continue. Freezing the carbon floor may help to limit some of the price increases, but as the UK's spare energy capacity narrows, prices are likely to rise, threatening the 2% target. Brent oil has fallen around 4% since our last meeting, to $107 a barrel, and the IMF have placed a 50% probability of this falling below $100 a barrel this year. Geopolitical concerns remain, with some civil unrest in commodity-rich regions. However, previous crises have only had a temporary effect on commodity prices. Therefore, as supply from North America increases, we believe oil prices are likely to have a slight downward trend, as shown by the graph, putting a downward pressure on the headline rate of inflation. Finally, annual factory gate inflation was at 0.5% in February, whilst input prices fell 5.7% year on year. Both of these statistics show little threat of inflationary pressure within a supply chain, especially as movements in producer prices take about 12 months to affect shop prices. However, many fear that as the economy recovers, firms will push through large price increases to increase their margins. However, margins have been protected in recent years by the weakness of bank lending, which has prevented new firms from entering and contesting markets. Therefore, as credit constraints ease, we believe competition between firms is likely to intensify, limiting increases in producer prices, providing a downward pressure to inflation. In summary, the outlook for inflation from the costs and prices section remains subdued, whilst any increase in inflationary pressure could be offset by tuition fees falling out of the CPI cycle in late 2015, which has added around 0.3 percentage points to the headline rate over the last 3 years. Now on to demand and output.
In the demand and output section of the economy, the key factors that have changed since our previous meetings are unemployment, which has fallen from 7.4% to 7.2%, and house price inflation, which has been steadily increasing over this time. This increase in inflation has sparked fears from the OECD that the market is overheating. However, significant regional disparities exist, with prices in London increasing by 10.9% over this time, significantly dragging up the national average. However, overall, across the majority of the UK, we believe the threat of a house price bubble is subdued as prices are still 25% below their pre-crisis peak in real terms, while affordability and indebtedness measures are far less stressed than they were during the financial crisis. Looking forward, with the economic recovery supported by the Help to Buy scheme extended in the 2014 budget to 2020, we believe this demand will increase, and it has supported an increase in supply. Also, with private sector house building up 20% last year. However, supply is still quite inelastic due to restrictions on planning and construction, and so this increase in demand does pose upside pressures. The consumption that has supported the recovery to date has mainly been fueled by the decreasing savings rate and the £12 billion worth of PPI payouts. However, payouts are slowing, and there is little scope for the household savings rate to fall much further without unwinding all of the deleveraging that took place during the financial crisis. And therefore, real wages must begin to rise in order to support the consumption and allow the recovery to continue. We expect this to happen in the second half of 2014 as average earnings growth overtakes inflation. And there is some evidence that this has already begun to happen, with private sector regular pay growth increasing by 2.2% year on year. There is also clear evidence of strong labour demand, with the annual rate and growth of job vacancies at 19% in the 3 months to January, increasing real disposable income, stimulating consumption, and therefore an upside pressure in the medium term. Despite this, we believe there is little threat of demand pull inflation due to the amount of slack in the labour market. Although there is falling unemployment, the level of underemployment has actually been increasing, with 8 million people now working part-time. And crucially, the percentage of people working part-time because they were unable to find full-time work is increasing, as you can see on the graph. Supporting this, the most recent Bell Blanchfire Index indicates that the level of underemployment may be as much as 2 percentage points above the Labour Force Survey figure. Therefore, we believe the level of unemployment is understating the amount of slack in the labour market, muting the impact of falling unemployment on inflation. A key area to assess is productivity, which has been falling over the past 5 years. However, and this is a stark departure from the trend rate of growth historically, as you can see on the graph. However, output per worker has increased in the first 3 quarters of 2013. Many fear that the financial crisis will have done permanent damage to the potential level of productivity in the economy. However, we believe some decline is due to temporary factors, such as a misallocation of resources caused by due to bank forbearance. However, increasing bank lending and investment suggests that this constraint is loosening. The relatively modest rise in unemployment suggests that fewer skills are likely to have been lost than in previous downturns. And so therefore, as the economy picks up, we believe productivity growth will increase also. Coupled with the 2014 budget, such as the doubling of investment allowance, this allows real wages to grow without inflationary pressure. Business investment is up 8.5%, signalling that the recovery is becoming more balanced. And investment intention surveys look promising, with the UK's Economic Sentiment Index at a 15-year high. Firms have plentiful cash reserves to finance more investment, and private non-financial corporations currently have £330 billion worth of cash deposited in UK banks. The lack of recent investment means that we expect a strong recovery, stimulating aggregate demand in the short term, causing upside pressures, but more importantly, increasing the productive potential of the economy in the medium term, a downside pressure. The effect that the aforementioned increase in demand will have on inflation depends on the amount of spare capacity in the economy, which we have decided to evaluate using several different business surveys, such as the Institute of Chartered Accountants in England and Wales Business Confidence Monitor, which indicates that over 50% of firms are operating at below full capacity. Although this has been on a downward trend, this is still above pre-crisis levels. And so it indicates that although the UK recovery is firmly entrenched, spare capacity still remains, allowing strong growth without inflationary pressure, but actually poses the risk of inflation undershooting the target in the medium term. And this risk formed an important part of our considerations. In conclusion, increasing house prices, while not posing the threat of a bubble, do still pose upside pressures, along with real wage growth. However, the level of underemployment and spare capacity in the economy, along with increasing business investment, justifies a low bank rate, as only when the slack has been used up will any price pressures appear. And altogether, there seems to be low inflationary pressure from the demand and output sections of the economy. Now on to financial markets.
A problem over the past few years has been that despite QE, the broad money, that is M4 growth, continued to fall due to the reluctance of banks to lend. However, broad money growth finally began to increase at the start of 2013, and this has continued into 2014, as shown in the chart. This was due to banks continuing to repair their balance sheet over the last year, resulting in the health of the financial sector improving significantly. One key indicator of the health of the financial sector is the capital positions of major UK banks. UK banks' core Tier 1 capital levels have increased by around £140 billion since the crisis, while the median leverage ratio of UK banks has fallen from 50 to 1, as it was during the crisis, to a much healthier 24 to 1. Both these factors signify that UK banks are in a significantly healthier financial state. As such, we expect lending to rise. Supporting this, as shown in the chart, Deloitte's most recent report on the cost and availability of credit revealed that the cost of credit has fallen dramatically since the peak of the financial crisis, while the availability of credit has increased and is now at a post-financial crisis high. Hence, business lending should pick up for 2014 and is forecast to rise 2.5% this year. However, at £417 billion, it is still 28% below the 2008 peak, and as the economy continues to recover, we expect lending to businesses, and therefore, as mentioned by my colleague previously, business investment to rise. This is especially clear when you consider changes to the bank's funding for lending scheme. These changes were implemented in January 2014, and they resulted in the capital offset for household lending to be discontinued and that for corporate lending to be extended. This should refocus lending to small and medium enterprises as opposed to the housing market, which the scheme did not initially do. Furthermore, banking regulators in Basel announced in January 2014 a loosening of leverage ratio requirements for banks after pressure from the banking sector had argued that the current conditions would stifle lending to consumers and businesses. This loosening of conditions, while not severe enough to affect the stability of the financial sector, will allow banks to report lower levels of overall risk, thereby reducing pressure on banks' capital. Therefore, we expect business lending and business investment to pose upward inflationary pressure. However, here is where the team had disagreement. The other members of the team felt that business investment will be a downside risk in the medium term due to productivity picking up, something which I disagreed with. I believe that any downside pressure as a result of productivity boosting the productive potential of the economy will take more than the medium term of 2 to 3 years to materialize due to the inertia developed by stagnant productivity. So the investment will mainly affect the demand side of the economy instead, an upward pressure. As such, the team agreed to take both situations into consideration, and this is reflected in our conclusion later on. Now, looking at equities and corporate bonds, the FTSE All-Share Index has been continuing in its upward trend and has already surpassed pre-crisis levels. Increases in interest rate expectations raise the rate at which investors discount future returns. All else being equal, this should result in depressed equity prices. However, as you can see, this has not happened. What this suggests is that investors may have become more optimistic about the growth outlook, thereby revising up their expectations for future earnings, dividend payments, as well as their expectations for interest rates. Hence, as investors receive higher dividend payments and the value of the investments rise, there will likely be a positive wealth effect, as well as a rise in disposable income for stockholders, resulting in increased consumption. Furthermore, firms are more likely to tap capital markets while the stock prices are high, and therefore business investments likely to be boosted further. Hence, as a result, both of these will likely result in stronger upward demand pull inflationary pressure. Summing it up, financial markets seem to be finally close to fully recovered from the effects of the financial crisis. Banks are healthy in lending again, businesses are finally gaining access to capital for investment, and equities have been continuing on their upward trend and have surpassed pre-crisis levels. Hence, we find that financial markets will have upward inflationary pressures, especially over the short and medium term. Now, on to international outlook.
With 49% of trade being done with the EU and 16% of trade being done with the US, these are the key areas of international outlook that we will be prioritising. In the Eurozone, the recovery is set to continue after an encouraging set of Q4 2013 GDP figures now showing 3 quarters of consecutive growth. Business growth accelerated in February, with the Composite Purchasing Managers' Index now at a 2.5-year high, showing that the moderate recovery is set to continue into 2014. However, outlook for the area is mixed, with significant national discrepancies between member states. Risks facing the periphery have diminished recently, with unemployment in decline in recent months. However, despite this, further adjustment is still required and will likely be hindered by the low rates of inflation across the area as a whole. Over the medium term, euro growth is set to continue, providing a boost to UK exports and an upside pressure on inflation. The US grew at a slower rate than expected last year, with annualised GDP revised down to 2.4%. However, we believe that much of this can be attributed to the unusually cold weather last winter. Strong February growth in non-farm payrolls and factory outputs both show that the US economy has bounced back. We interviewed Paul Dales of Capital Economics, who confirmed our analysis that a period of strong growth and increased consumer spending lies ahead for the US. Given this US recovery, there is plausible upside risk to be felt by the UK economy if the recovery continues quickly. Fed tapering has been a contributing factor in recent emerging market volatility, partly causing a sharp reversal in capital inflows and currency depreciation in these countries. Financial conditions have now improved, but the risk of slowdown remains. Slowdowns in emerging markets will probably have limited direct impact on the UK, but more widespread financial market disruption and indirect trade linkages would have a more significant impact. Finally, we have analysed China as a potential downside risk to the UK economy if the Chinese economy were to stall. However, given our limited trade with it and various Chinese economic policy adjustments, any downside effect would be felt through indirect transmission mechanisms. In summary, the outlook for global growth has become more balanced and improved. Upside pressures should be felt, however, downside risks still remain. To conclude, we recognise the prevalence of upside pressures on the UK economy. These include unemployment and falling unemployment and increased energy prices in the short run, and the global recovery and the pickup in house prices over the medium term. However, on the downside, there exists low import prices, spare capacity, the downward trend in commodities, and the likely increase in investment aiding productivity. Yet the significance of these upside pressures is mitigated by various factors. For despite falling unemployment, there is still significant slack in the labour market. Despite increased energy prices, tariff rises have been smaller than previous years. Despite global growth, there is still significant uncertainty in the Eurozone. And finally, despite the increasing housing prices, house prices are still beneath their pre-crisis peak in real terms. Therefore, we have decided that given the magnitude of these downside pressures, they are a far more potent concern to be addressed, and this justifies a low bank rate. We have also posited different scenarios for the UK economy standing as risks to the 2% target. On the upside, there could be stronger than expected US growth driven by consumers. With the UK's strong trade linkages, we would be ideally placed to benefit, boosting growth and possibly leading to inflationary pressure sooner than expected. Secondly, productivity may not pick up as expected, the implication being that the recovery could quickly generate inflation, given that in this scenario, output would be close to its full potential. On the downside, a strong euro combined with slow growth could push the Eurozone into deflation. This would see UK exports plummet, causing the recovery to slow, with the possibility of imported deflation. Finally, we may be underestimating the amount of spare capacity, which could keep underlying inflation excessively subdued, in turn causing CPI to fall even lower. These considerations fed into our inflation forecast fan chart. Ultimately, therefore, our analysis exemplifies the little threat of inflationary pressure over the forecast period. In light of this persuasive evidence, the Oundle School Monetary Policy Committee has decided to maintain the bank rate at 0.5% and maintain the stock of asset purchases at £375 billion. Finally, with regard to forward guidance. We intend to maintain forward guidance in its current form, analysing key economic indicators to assess spare capacity in the economy. We also intend to begin releasing a graph based on members' expectations for the bank rate over the short, medium, and long term. Each anonymous dot represents the view of a member of the committee on where they see the appropriate level of the bank rate to be over coming years. The intention of this is to reduce uncertainty over future rate rises, increase transparency, and provide further guidance. This would also help to reflect the plurality of views that exist within the committee and counter the perception that rates are likely to rise in the near term, adding credibility to our forward guidance. The simplicity of this graph would provide an easy, simple to understand message to businesses and consumers. It is also important to point out that in reality there would be 9 dots to represent the 9 members of the Monetary Policy Committee. Thank you very much for listening.
Hugh. Thank you. Yeah, you mentioned you've done some special analysis on China, and people often ask what could go wrong with the Chinese economy in terms of affecting the rest of the world, and what is there to suggest that actually things will carry on as before, and how might that affect the rest of the world, including the UK? So could you articulate a bit more the upside and downside risks from China for the UK?
I think the most important thing to note is that this slowdown in China is a planned slowdown. As part of their 12th five-year plan, they have said that they're going to lower their growth rate to 7%. And so what we're seeing isn't a Lehman moment. This is a planned, controlled slowdown, and therefore we don't see the effects of the what people are calling a potential Chinese implosion to actually be that great in reality, given that the Chinese Economic Policy Committee are doing so much to control it.
And I think especially when you're talking about what could possibly go wrong with China, we're seeing the first signs of what many people are pointing to as being China's black swan moment, that is the corporate debt default that we've seen two of in the last 3 weeks. And the issue here is that China's known that it's had a housing market problem for the past several years. And this is the Chinese government's response, that normally they would bail out these banks, but in these special scenarios, they're leaving the banks to fail because this is how they're going to weed out the bad banks. And this is not something that's unexpected. China has clearly made a stance on this, and we found this out when we interviewed the Minister Council for Education at the Chinese Embassy in London, Mr. Sheng, who said that this is something that China are strict on because they do not want to go into the Lewis turning point with a lot of instability in their housing market. And China's biggest thing, though, with their housing market, though, is that it's not quite as leveraged as the housing market was in the US and Japan when it went all wrong, even though the size of the housing market to GDP is roughly the same. This is because China's interest rates have generally been rather low in previous years. So the Chinese people have used housing as an investment, as a saving mechanism. And so should corporate debt defaults happen, most of China's debt is internally held, so the effects externally would not be as wide as it was with Lehman Brothers. Although the biggest risk here, if China does implode and growth does stall significantly, the biggest concern would be China would bring commodity prices down with it, and that would have severe deflationary effects. And also the concern would be indirect trade linkages. The EU as a whole has China as its largest trading partner, and the US has China as its second largest trading partner. So in these cases, considering we have most of our trade with the EU and the US, the indirect trade linkages there would severely affect us. However, we understand that there is a possibility of China stalling significantly, but we personally find this possibility is very low because the Chinese government has a key track record of controlling their own government. For example, in 2008, when we first saw signs of Chinese growth stalling, China's government included a $568 billion expansion to protect the government, and this shows that China has a key track record in protecting its government. And as such, we find that Chinese growth, although it will likely slow as it moves towards a more tertiary-based economy, this is not a risk for the short or medium term, and more something we look at maybe 10 years in the future.
And just on another subject, the housing market, I think you painted rather a benign picture, but the FPC, as has been noted by others today, put a statement out noting that the sharp increase in high loan-to-value mortgages and so on, and increase in those sort of products. Are you concerned about that aspect of the economy, and how you feel about it relate to what the FPC discusses with you, or what the bank corporately does about it?
Well, what came out yesterday was that the Bank of England feels that it's important to assess the amount of instability, the financial instability, because it's come out that people spending a higher proportion of their income on mortgages for a lot than previously. And so therefore, even though prices are increasing, this actually supports our argument for keeping interest rates low and stable, because so many people depend on mortgages and mortgage payments that if we increase rates quickly and by too much, it will have great shockwave effects onto the financial market. And so despite there being increasing house price inflation, we do still believe that the best thing to do is to keep rates low and increase them gradually.
The Bank of England's own analysis has supported this. They released a report, I think, last year where they modelled a prediction if interest rates to rise to 2%, and they found that the percentage of stressed mortgages there were, which are defined as people who spend more than 35% of their disposable income on debt repayments or mortgage repayments, it would jump from the 8% it is currently to a 16% if interest rates were to rise by 2%. And this did inform an important part of our policy prescription, because we want to wait until real wages can rise and people can start to pay down some of their debts before we raise interest rates. And also, something the Financial Policy Committee could do was a Help to Buy scheme, where we can't directly influence it, apart from Part 2 was a part that encouraged the enormous amounts of 95% loan-to-value mortgages that have been given out. Apart from the Part 1 that's being extended to 2020 is only the equity scheme. So that's only when the government takes a 20% equity part of. Then it only applies to new build houses as well, which means that should stimulate housing supply as well as demand, hopefully limiting a cap on price increases.
And following on from that, one other thing that the Financial Policy Committee could do is they could use directions under the SCR, sectoral capital requirements, where in using this, they would directly order banks to increase the amount of capital that they hold in specific sectors that they find being risky. In this case, what we could do with the Financial Policy Committee is increase the amount of capital banks must hold in the housing market, or more specifically high-value loans, which we see as being more risky. So this is something that the Financial Policy Committee, we are asking to keep a strong eye over, and we will assess this as it comes along in the future.
You're asking the FPC to do that?
Yeah.
The Handel FPC will deal with that. Great. Ian.
Thank you. I wanted to ask how you think your policy decisions might evolve over the course of the next couple of years or so. In particular, the relationship between how the economy is developing and how you might change your policy decision. When do you think the degree of spare capacity that you talked about that currently exists will be used up? And when, relative to that point at which capacity is finally reaches what you might term full capacity, would you start to think about raising rates?
So Charles Bean actually said recently that spare capacity is being used up by businesses because they're reluctant to invest in new capital expenditure because they don't know whether they'll get returns on this yet. And so we do see spare capacity being used up eventually, but kind of saying when this will happen is obviously a very difficult forecast to posit.
Further to Juliette's point, the forecasting when we're going to raise rates will depend on the size of the output gap as to how soon we think the economy is going to create inflationary pressure. So the output gap can be compiled using two things: the amount of spare capacity in firms and the amount of spare capacity in the labour market. Now, Martin Wheel last week came out with a speech suggesting there was around 0.9 percentage points of spare capacity in the labour market. However, we think this is slightly understating the amount of spare capacity, mainly because in the forecast that he created, he modelled up to 2016 that the size of the population would stay constant and the size of the workforce would stay constant as well. And we've realised that over the next 2 years, the size of the workforce is likely to increase by 2.5 percentage points, mainly through increased immigration, growth in the population, and benefit reforms done by the government which are encouraging people to go back to work. And therefore we think there's greater spare capacity in the labour market than maybe Martin Weir was suggesting in his speech. And also, as we saw the spare capacity from Freddie's section, spare capacity in firms is also 10 percentage points above where it was before the financial crisis. And therefore we believe that the amount of output, the size of the output gap with the amount of spare capacity in the economy is quite large, and therefore rate rises can be held off for a while.
But does that mean relative to where the market currently expects the first rate rise to occur, which is sometime roughly in the first or early second quarter of next year, that you would expect it to be later or sooner?
We had our forward guidance charts, and I think the different dots represented that most people expected. You can go back if you like. Most people expected a rate rise in 2015. We're not entirely sure when that will be in 2015. However, we think that in 2015 there will be a significant. We will think that over the 18 to 24 month time lag associated with monetary policy, there will be small enough spare capacity to begin to create inflationary pressure over our forecast horizon. However, of course, this will be subject to revisions in any data that we get in meetings before we raise the rates.
Also, it's important to note that when it's not just exactly the moment we increase interest rates, but the fact that we will increase them gradually. And also, we are aiming to reduce the amount of spare capacity through our policy decision, and so they will impact on each other. And so if spare capacity does not fall, we will not increase interest rates.
I'll move on. But Ian has an office next to Martin, so he's going to take him back and tell him he's done his sums wrong, which would be quite good.
Half an hour is a very good speech.
In the first one, I just wanted you had your own inflation forecast at the start. I want to know what process you went through to get it, what sort of assumptions did you make? And then how did you step off of that to get your individual dots? Did you rerun whatever process it was, or did you stick in pins relative to your central projection, or what did you do?
So we're going to start just by explaining the dot chart first. And both did inform each other. So we used our fan chart to then look at the way we interpreted these various risks and pressures that fed into our creation of the fan chart, which I think Ollie's going to expand on. And then we each, independently and with the knowledge of each other's different sections, put where we thought, where we would move the bank rate to from this period. And obviously, the dot chart goes further than the fan chart does. And as you get towards the long term, obviously these points would be subject to movement depending on what happened in the market. But I guess in that respect, it's better to focus on kind of 2014 to 2016. And I know we each have our own reasons as to why we did what we did in terms of placing the dots.
So with the CPI fan chart that we made at the beginning, the way we constructed that was taking the main pressures we thought from each of our sections and then thinking of how much of an influence they were likely to have in the short, medium or long term. And then to confirm this, we also interviewed 3 different economists, Paul Dales from Capital Economics, Mark Gregory, Chief Economist at Ernst & Young, and Rob Hadron from Centre for Economic and Business Research. And we showed them our fan chart, and then we took their feedback and then sort of adjusted it as to where we thought, and up to actually yesterday when we revised the fan chart again, due to new data coming out, such as retail sales were up. And so we thought that could provide a bit more of an upward pressure. So it's been updated quite recently to represent new data releases coming out.
No, you haven't. No, go on, you have go on.
I'd like to ask at least one unfair question. Like a number of other people, you noticed that M4 didn't grow very much after QE. Is that because QE didn't do anything, or is it because QE would have plummeted M4 would have plummeted without QE? The unfair bit.
Well, we think the consideration here is that the main reason that we feel M4 didn't rise even despite QE by very much is because the reluctance of banks to lend due to their balance sheets being severely damaged from the financial crisis. However, what we feel is that without QE, M4 growth would have plummeted even further because that would have meant banks would have held back more capital from themselves. And I feel that the fact itself, the economy is starting to show signs of recovery, and the fact that the banks are now starting to release the M4 as soon as their balance sheet is starting to improve, shows that the QE growth was actually successful in the sense that it did help boost M4 growth in the economy, even though it had a slightly larger than expected time lag.
In the 10 years the MPC existed prior to 2007, the average level of bank rate was 5%. In your chart here, you say in the long term, when presumably the economy is, you think bank rates can be somewhere between 2 and 3. So why do you think it's going to be so much lower than it was in the 10 years, averaged in the 10 years prior to 2007?
So as a team, I think we do all agree that the natural rate of the bank rate has fallen, and this 3% is what we see as potentially the new natural level. And obviously, it's difficult to firmly posit what that would be, but I think generally 3% is a good estimate of what the natural rate would be, given the structural changes that have occurred in the economy after the financial crisis.
And following on from that, she mentioned structural changes, and we specifically mean structural changes in financial markets. So we see that the risk appetite of most investors and banks has fallen significantly. We're not going to be seeing leverage ratios of 50 to 1 and so of the sort anymore, because we've seen what can happen. And as such, we feel that the risk appetite has been severely decreased, and as such, it will take less of the bank rate should be lower for it to stimulate the same amount of growth.
Further to that, the way you could think about what the equilibrium rate of interest rate is to take the 2% inflation forecast from the MPC and then to add on the risk-free rate of return. So before the financial crisis, that was about 3%. However, like Maliandi has said, because of availability bias, because the financial crisis has recently happened, many people, what they would used to associate a 1 in 100 chance of happening, they may now associate a 1 in 50 chance of happening. And this has meant that many people are now more willing to buy safer assets, and therefore this has increased the price of safer assets, driving down the yield, and therefore the risk-free rate of return has declined significantly, and therefore that could have been driven down to about 1% or possibly even 0.5%, which is why you see our longer-term dots at a much lower rate than they were before the financial crisis.
And adding on to that, just conclusively, we know that financial markets have very short-term memory. So this long-term we're referring to here is the next 5 to 7 years. We could see perhaps in 10 years we might see an increase in the risk-free rate, but this is our prediction for the next 5 to 7 years.
Okay, that's brilliant. Well done. Well done. Thank you.